If you were paying attention in the fall of 2008, you remember the panic. Overnight, the entire global economy felt like a house of cards collapsing under the weight of toxic mortgages. That visceral fear was the starting point for the relationship we have with money today. When the dust settled, the reality of too big to fail set in. Everyday citizens lost their homes, their jobs, and their life savings. Meanwhile, the executives who engineered the collapse walked away with their multi-million-dollar salaries and golden parachutes intact. The central banking system stepped in to save these failing institutions. The Federal Reserve authorized billions of dollars in loans, like the massive $85 billion bailout for AIG, while demanding zero accountability from the leadership that caused the crisis in the first place. Seeing that lack of consequence created a massive generational vacuum of trust. Public outrage spilled into the streets with movements like Occupy Wall Street. People knew the system was rigged, but the frustration had nowhere productive to go. That's because the public is burdened by a deep cultural vulnerability, the money taboo. We live in a highly capitalist society where we are taught to equate wealth with personal worth, yet it is considered rude or entirely inappropriate to openly discuss our finances. Keeping quiet isolates us. If you don't discuss your salary, your heavy debt, or your investments, you miss out on learning basic financial mechanics. You're left navigating behavioral pitfalls entirely alone. Take a population that has lost faith in financial institutions, isolate them with a culture of silence, and you have the perfect prey. The financial sector knew exactly how to reinvent itself to capture this audience in the digital age. After the 2008 fallout, Wall Street needed a rebrand. Tech companies and financial institutions merged, promising to democratize finance. They offered sleek apps and instant accessibility. But beneath the slick interface, they were mostly just digitizing the same old predatory traps. Take the explosion of buy now, pay later services. These schemes are explicitly designed to bypass our critical thinking. They target human behavioral flaws by offering the immediate hit of instant gratification right at the checkout screen. Splitting a purchase into 4 easy payments feels entirely frictionless. That seamless UI design successfully masks the reality of the transaction. You don't feel the pain of parting with your money, which makes it remarkably easy to quietly accumulate deep consumer debt. While digital credit apps lure consumers in, a different kind of friction is locking the housing market in place. This is the lock-in effect, a macroeconomic byproduct of our current interest rate environment. This chart shows exactly how that paralysis works. Look at the sharp upward line representing modern mortgage rates, contrasted against the flatlining data of housing market inventory. Existing homeowners who secured low rates years ago simply cannot afford a new mortgage today. This freezes social mobility. People can't relocate for better jobs or growing families. Modern financial technology promised to open up wealth building for the middle class, but in practice, it digitized their debt and higher rates locked their homes in place. This illusion of access is even more pronounced in the stock market. Research from the CFA Institute has documented the aggressive gamification of retail investing on platforms like Robinhood and Webull. This diagram shows the psychological exploit. Left, System 2 thinking, slow and logical. Right, System 1, rapid and emotional. Apps push users into System 1 using UI tactics. Confetti rains on trades. Constant notifications and social features create addictive dopamine loops. But why do brokers want you trading constantly on a platform where trades are supposedly free? Because they are quietly making money through a mechanism called payment for order flow. This flowchart maps the real transaction. When a user places a free trade, the broker sells that data to institutional market makers. The market maker executes the trade, shaves off a tiny profit, and kicks a portion back to the broker. When millions of users are nudged to trade impulsively, those fractions of a cent turn into billions of dollars. This high-velocity environment is exactly what fuels massive, irrational market events, like the intense volatility we saw with meme stocks. The stock market was gamified into a casino for a specific purpose, to systematically extract retail wealth through high-frequency engagement. Public access was merely the first step in a larger loop designed to capture and monetize user trade data. All of these individual debt traps and modern market pressures are now actively colliding with the great wealth transfer. We are approaching a moment where the entire ownership structure of the global economy begins to move. This visualization represents the staggering scale of what's coming. According to data from UBS, an estimated $83 trillion in private wealth is set to change hands globally over the next 2 decades. It is the largest transfer of capital in modern history. But the generation inheriting this wealth isn't playing by the old rules. Scarred by the 2008 betrayal and burned by modern digital debt traps, they are flatly rejecting the secretive, closed-door nature of the old guard. They are actively dismantling the money taboo. Instead of navigating financial mechanics in isolation, they are forming open peer communities. They are sharing their salaries, comparing their net worth, and treating financial education as a collaborative effort. This translates into entirely new defensive strategies. They are embracing the FIRE movement, aggressively saving to achieve financial independence and retire early, while heavily directing their capital toward impact investing and sustainable assets. Survival in this predatory architecture depends on radical transparency. A new app or a government bailout cannot fix the underlying culture of silence. We must finally break that silence to safely navigate the largest wealth transfer in history.